Welcome to FOMC Live, ladies and gentlemen, the moment you've all been waiting for. Yes, there is a poll in this live stream that is asking you, is this the true move by Bitcoin? And so far, some of you, 325 of you think that this is not a real move. Well, what do we know? We don't know nothing until Powell decides to step up to the panel and start revealing what his intentions are with regards to the US economy. So let's just bring it all back right now. The European zone cuts the interest rates. The UK is on course to cut the interest rates. Canada cutting interest rates. Man, we've got these economies doing more cutting than a Michelin chef. Like, this is very important. So what's the stalling process from the Federal Reserve? Why are they just like, sit tight, man? We want to cut, but we don't want to tell you that we don't want to cut. But we don't want to tell you we're cutting just yet. Why? Look, the US has got a major debt problem, and the most sought after asset is the US debt. Most of the foreign investors are going to be picking up US bonds because of the yield that it generates. So prior to this morning's CPI data, what did we see? We saw the yields at 4.8%. So in 2 years' time, I expect to pick myself up 4.8%. It's the expectation of a return holding US debt. Now, that yield has just slumped. Everyone's now gone into the bonds. Everyone, according to an article, is pricing in the idea that the Fed is going to cut. The only thing that would ruin this is if Powell decides to turn around and say, we need a bit more data. But it's true, though, because we've been in this range of 3.1% to 3.4% on inflation for quite some time. There hasn't been a significant reduction in interest and in the inflation. And I actually believe that Powell is going to put this out there, even though we saw the nice data come out today and the market is all-time high. You know, value is like super right now in the stock market. Assets across the stock market are way above value. But people are now still sat in money markets. Is this going to be the truth? Could what we see happening right now in the stock market be the start of something massive? Because if $7 trillion is sat inside of the money markets, that means they're only looking for what? Safer investments. They're not looking for high risk. That means government bonds. And you've got yourself an election coming up. The dollar is battered. The dollar has lost 25% of its purchasing power. What a perfect time to try and get it pumped up just that little bit more. Even though the dollar's dropped today, it's still depreciated by 3%. That means you can still pick up a few more euros on the back of a strong dollar. That's how they're going to see it, ladies and gentlemen. Now, in tonight's live stream, we're going to be doing a couple of things. We're going to hear very shortly for the actual FOMC statement. Then we're going to get the federal funds rate. Someone asked the question, what if they actually cut the federal funds rate now to 5.25%? It will do exactly the same thing what happened with the US dollar and the Swiss franc. Man, they at the last minute decided, you know what, we're gonna cut our interest rate. Boy, that was a 300 pip move that happened on a Sunday night. The dollar they did not expect that, okay? And it literally slumped the dollar, and then happy days for the Swiss franc. So something like that on the US. For the US interest rates, I don't think they would do such a thing. Only something drastic would have to happen for them to say, yep, we're going to cut it in the next 20 minutes. Boy, ladies and gentlemen. So once we get through that, what I'm going to do is going to break down a little bit of price action. I'm going to be diving into your comments as well about whether this move is the true move of Bitcoin and what we can expect going into the actual press conference. We're going to watch the press conference, and we are going to keep a tally of how many times this gentleman, Mr. Jerome Powell, does actually cough. The last FOMC meeting, he coughed around 45 times. Some guys had counted it. He coughed around 45 times. And every time I watch Jerome Powell have this conversation with the press, it just makes me laugh, because every time he answers a question, he's either repeating the answer from the last question or he's just trying to narrowly avoid answering it. And the only people that I pay attention to are Wall Street Journal, the Financial Times, Gina, she's be careful of Gina, man. Like, redhead, like, boy, like she's She's in for Powell, I'm telling you now. But more aside that, okay? We're looking for Reuters as well, and of course Bloomberg. But anyone after that, I mean, last time we had Napoleon Dynamite interviewing Jerome Powell, and I hope he's there today. With that being said, ladies and gentlemen, let's get to the chase of it all. Mad love and respect for everyone passing through. If you are new to today's live stream, be sure to like and subscribe. Let's have a conversation, and I do hope you like the attire this evening. Yes, we're pulling out the good numbers. Earlier on was just CPI celebration, and then this one is for the FOMC. We even had a little bit of a shave as well, man. We gotta get sharp, man, you know. Tino, isn't it odd that I'm spending more time with you than your girlfriend? Ah, man, your girlfriend must be pissed. Anyway, mad love and respect, guys. Let's get with the program. Let's get with it. Here we go. So, what have we got? Stocks climb as bond yields sink with Fed in focus. Let's focus. Here we go. Going into it all. Well, just a quick update. I know I spoke about it earlier on, but the setups that I sent out earlier on have pretty much come through and completed their projections. So those were the setups from earlier on today. Euro, we saw the nice sweep to the upside. Happy days. Of course, Bitcoin has done the delivery. It has actually stalled around the psychological high. If we just go over to Bitcoin right now and have a look at that, you can see it actually swept up towards that point. Happy days. So I'm really happy with those projections that came into play today. So most of the platinum members have made a penny or two. So if you want to take part in that, you get 20% off on your first month if you do want to take advantage of trade setups. I cover 6 asset classes. The Euro, gold, oil, Bitcoin, Solana, Ethereum. We throw in the NASDAQ and the S&P, so it's actually 8. And so far, out of 890 setups in the last 6 months, we're scoring around an 86% win rate on those setups, but that doesn't include the weekly outlooks, and it doesn't include the setups that I give after the New York live stream. These are just the fixed ones that I give at the start of the trading day. Now, you want to check that out, tradersreality.com. Now, let's get with the program. Here we go. So, what have we got going off with BTC? Well, we've got so much happening, ladies and gentlemen. We're going to be having the book map to the left of the chart. We're going to have, of course, Powell, Jerome speaking. And, of course, stocks. The yields are so important right now, guys. Again, let's go back into the yields. Let's roll over to it. Here we go. 2-year yield taking a bit of a shoe bag to the downside. And let me tell you something. This happened before, man. I'm seeing it again and again. The volatility in the yields is showing you that there's no consistency with what's going on. Hear me out. Do you remember when the yields actually took a slump to the downside? What day was it? What day was it when they did that move? There was a move to the downside by the yields, and it was quite a significant move. Oh, I've forgotten what day it was. Where were we? Where was that move on the yields? It was a sharp move. Nah, you'll remember it. And I said to you guys, look, this big move to the downside in the yields, be mindful of it because it could lead to a retrace. And then the retrace happened. We've effectively got the same story happening right here. Could they be picking up the bonds now or selling bonds? Because remember, the bonds market is junk. It really is junk bonds when you think about it. Okay, look at the 10-year right now. Back up at 100. We filled the imbalance. Imbalance for imbalance. We understand that when they buy, they sell, and when they sell, they buy. What do we mean by that? Well, just to put it simply, you've got this. Look what's been going on. Bitcoin's been dropping, and someone in the channel today was like, oh, yesterday he was bearish, and now he's bullish. Man, bro, have you been watching what we've been saying? I have never been bearish. Think about it. I want prices to drop so that can solidify the idea of them buying, because look what's happened today. We've had some dudes plant $28 million worth of longs in Bitcoin on a bid. Where is it? I just had it there. Come on, where is it? There we go. $28 million worth of longs at 67,000. That is very, very bullish. Remember, when prices drop, I am favoring the drop because it tells me how frequent the buyers are going to step in and show support. Because people are going short on the drop. Look at this. They're going short. Look at this dude here. He went short at 66,342. What a great brain that he has. Because he's he's getting the food from all these crypto influencers. Speaking of which, ladies and gentlemen, Andrew Tate has decided to say he wants to start doing crypto podcasts. Who should I talk to? A gentleman recommended me. Thank you very much, Harry. And I decided to comment. Now, I can't say what I commented on the live stream. But if you go to that post, you'll see my comment. Could you imagine? I mean, come on, man. Andrew Tate, like, that would be absolutely madness if he wants to start talking to me about cryptocurrency. With the exception of Jason Casper, okay? Who else could they talk to in cryptocurrency? Like, that'll bring flavor. You know, I think if me and Jason were to go on there, then happy days. Like, boy, like, it's Jason, man. It's my boy Jason. It's all good. But anyone else? I mean, I'd be bored watching anyone else. But I'm always going to say that. But hey, go check out that post, man. Let's spam it up. It's a chance. Who cares if we get it? Who cares if we don't? But we're the top G's here, man. We are the pattern watchers. Like, anyway, forget that. The bond market being at a 10-year high, right? Not a 10-year high, sorry. The bonds market shooting up. As they said last night, that they are now pricing in the idea of maybe a Fed cut in September. Or are they actually going to the bonds because they're a little bit concerned about the economy? It just doesn't add up, okay? Remember what we said in the live stream earlier on. The US's real interest rate, okay, is right here. The real interest rate, that is when you factor in inflation, okay? Now, if the euro's going down in terms of interest rates, Canada's going down in terms of interest rates, the UK is projected to go down in their next meeting. They want to cut because the economy itself and the labor market is starting to cool off. They don't want to cause a recession now, do they? So the idea is that the dollar is the only lucrative thing right now in terms of assets, or should I say fixed income securities, bonds. Why? Because the yield is there. So all the traders yesterday have picked up their bond yield. They've locked in that 4.8%, and they are laughing their heads off because they've locked in 4.8%. Now everyone's going to try and scurry over to the yields market, but it's all going to be determined if Powell does decide to say that the rate cut is going to happen this side of this year. And the crap thing is they won't actually reveal if they are going to indefinitely cut. That's the thing. They're not going to say, yes, we are going to cut, or yes, September should be in time for a cut. He's going to start talking about maybe all the federal board speakers, all the speakers in the Federal Reserve, we're all coming to an agreement that, you know, to cut the interest rates might be a little bit of a hesitant thing to do. We need a little bit more data. And they're even talking about a boring FOMC. The second I get any boredom from this FOMC, and I'm getting more interest in the amount of times that Powell is coughing as opposed to actually giving us information about what he's going to do with the US economy, I'm killing that live. No chance. And I'm going to put a petition in to get me into that FOMC meeting. I will do it. I will get there one day. I just, if Napoleon Dynamite dude can get into it, I can all day. At least I hopefully come with a better dress sense. That guy looked like he just finished his second period maths lesson and thought, oh, I better go and speak to Powell. Anyway, it gets me frustrated, man. Like the economy relies on these people, and it's absolutely crazy. Like you go out and you see kids on the street, or should I say students, the people of tomorrow. See, I look at university students now and say, okay, what is ChatGPT going to replace? It's going to replace you. It's going to replace you. It's going to replace you. That is true. ChatGPT now is going to replace every single one of these people that are going to university. Why? Because they're all standing on corners, getting pissed out of their faces, and they're meant to be the people that I should be taking my family and seeking advice from in regards to maybe mortgages, properties, or you name it. Well, won't be relying on those people. I haven't needed to rely on them. But I was a student myself. And what did I learn at university? I learned how to be resourceful. I learned how to research. They didn't teach you nothing about trading. But my lecturer did call the subprime mortgage crisis of 2007, 2008. And he was a top boy, man. He was a top boy, you know? He was a good guy. I liked him, okay? But anyway, besides that, where we are right now with BTC. So the poll is in 1,000. This is what I understand. 1,152 of you have voted on whether you believe Bitcoin's move to the upside is true or false. Yet there's only 328 likes. My days, man. The math doesn't make sense. Exactly the same math that doesn't make sense with regards to what's going on in the US economy. So let's just quickly refresh this bad boy right here. And you can see inflation is down, CPI right there, 0, and the core price is coming in lower as well. Let's look at the trend on the core price. Is it really anywhere that we're concerned with? Or should I say, should we be worried about it? Are we seeing a trend? Look at it. February, 0.4, 0.4, March, April, 0.4, May, 0.3. Okay, now it's coming in at 0.2. There is no clear trend per se. It's like we go up and then we go down. We go up and then we go down. We had these 3 increments of 0.4% on the core price. That tells us that manufacturers are keeping the price of goods and services higher. Now, wait for it. This core price does not factor in the idea of oil going up, and oil has been climbing up nicely and heading towards that $80 mark. That is a problem, ladies and gentlemen, because even though oil's price is not factored into the goods and services, okay, excluding food and energy because it's too volatile, the problem is people are going to experience the pain of higher oil prices, and manufacturers are naturally going to increase their costs yet again, even though they don't factor in oil and food. Food and energy. They don't factor in food and energy in their readings on the CPI, but they focus primarily on the price because that in principle is going to reflect it in some way, shape or form. Okay? These are all things that you really want to put into your mind when you're deciding to take an interest into cryptocurrency, all right? A lot of people right now have seen Bitcoin make a nice move to the upside. We go into the daily time frame on BTC for my holders and where we at. We're seeing volatility. We still got a bit of a vector candle region right here that I would ideally want to see Bitcoin try and recover, and that'll be good news if they can recover it, but I'm going to take you back to another day. I'm going to take you back to this day. And I'm not saying it because, oh, Tino, stop being negative. I'm bringing you the real way of thinking here. Do not be in the clouds. Be like, oh, yeah, Bitcoin to the moon. I'm all down for Bitcoin to go up, ladies and gentlemen. But be careful of the little trickeries they like to pull. Do you remember that day on the Friday, non-farm payrolls? Yeah, Bitcoin made a nice sweep to the upside and then instantly reversed it. We want to make sure that if we do see that similar behavior here with Bitcoin, that you are closing out your profitable positions as you see that fast move up. We've got up until this point right here for Bitcoin to really finalize the vector candles in this range, because when we look at it from this perspective, you can see that that's all there is inside of this area, which is that red vector candle on the daily time frame. After that, ladies and gentlemen, it's free for all. Like there's nothing else for them to recover as we move to the upside. It's just all-time highs coming into play. Now, with that being said, we go over to the S&P and the NASDAQ, and you can see the NASDAQ and the S&P are up. And I'm talking significantly up going into where we are with the stock market overall. Let's just have a look at how the stock market is faring right now. Here we go. 4 days on the NASDAQ. Look at that, man. Exposure in the stock market is 80 to 100%. 80 to 100%. And who's winging it? Who's making it happen? Tech. Tech is making it happen. But we can marry up the idea that, is it really a sustained rally to the upside? 819 stocks are up on volume, and that was from yesterday. Can you imagine what it's going to be right now? But the problem is only one stock is breaking out. That's a problem for me. So we've got a couple of stories that are coming into play here. Hold on. One stock is breaking out, but 819 stocks are up on volume. What does that mean? Well, it means that there's not enough stocks breaking out and from their highs. That means most of them are trying to come out of accumulation. So they're getting ready to start working up. The more you see breaking out, showing more figures or more stocks, then that can add weight to the idea of assets moving higher for longer. Okay? So with that being said, 80 to 100% exposure in the stock market. Apple is fueling the rally. We go back into the bonds. Can we justify that? The bonds are going down, and the yields, they're going down. So when the yields are going down, it means it's going to cost tech companies less money to do business. That's good news. So naturally, that's going to end up sending assets up across the board. Nvidia. What did we say, man? Look at that. $200, man. Look at that big spike up. Happy days. What a wild thing. Tesla, doing pretty well. GameStop, not doing too bad. Meta, okay. Microsoft, killing it. Apple, well, what do you want me to say, ladies and gentlemen? It's just absolutely killing it. Absolutely killing it. So we're getting into it now, ladies and gentlemen. Here we go. We have now got the data coming out in a split second. 3 more minutes into it. 3 more minutes into it. Where we at? 617 likes on the live stream. 2,487 of you beautiful people passing through. Let's just quickly review this poll. 1,415 votes are coming in saying, oh, you're pretty much even Stevens right now, ladies and gentlemen. You are even Stevens right now. 53% of you say that this move is not true. Yet 47% of you say that the move is true. We're going to know very, very shortly, ladies and gentlemen, what the story is with BTC. So what we've got here is Bitcoin's price over here. We want that imbalance over there on BTC to try and get recovered. We've got the order book right here for Bookmap. For those of you that don't know, Bookmap is an order flow tool. It gives us the heads up on the relationship of the bids and the offers. This is going to be important when we're watching the FOMC. Why? Because we're going to see if they're looking to sell, that means price is going up. And if they're looking to buy, price is going down. If you sat there scratching your head thinking, hold on, what do you mean by that, Tino? Pretty simple. Limit orders. They buy at the lows and then they sell at the highs. You heard about the old school saying, buy low, sell high. It's over here. Look. Here's your greens. These are where they're buying. A bid order of 66,900 comes in at 10.35 million. Happy days. They're buying. And when they're selling at the top side over here, you've had 8.95 million sold at 70,000. Awesome, because it's a sell order. Ask, offers, bid, buy, ask, offer, sell. Okay? With that being said, going back into it all, let's pull the price up. Here we go. We have got 2 more minutes, ladies and gentlemen. Well, yeah, just under 1 more minute before the party gets started. And then we have 30 minutes. What I'm going to do is just go through some altcoins for you guys. And then we get ourselves ready for the Bitcoin on-chain analytics. And we're just going to have a little bit of a conversation for 30 minutes. And then we will then listen to the dearly beloved Powell and how many times he can cough. So shorting until I'm 5'2". Wonderful. Any potential? Listen, guys, look, if you're looking for setups in this scenario, okay, just be very careful, man, because right now, open interest is probably going through the roof. Investors are putting their money, they're borrowing money from exchanges, leverage, and they're going to be hoping that Bitcoin pumps. And you know what? Most of them will be right, okay? Bitcoin will more than likely pump, okay, hypothetically. It pumps. Will they do anything about it? No, they won't. They'll just leave their positions open, and then they're going to hope that it just keeps on going. I hope Bitcoin explodes from this point. I really do. Because at the end of the day, if you guys are making money, then it's happy days for me. We want everyone to be earning a penny or two. But this game of trading is a zero-sum game. One man's fun is another's hell. And when you understand that, the next time you look at your position... Okay. It's not moving too fast. Okay, it's not moving too fast. Wait for the vector recovery. Wait for it. Look at those bids. They're coming in. Pick it. 66 on the bids. 66% on the bids. 75 on the bids. They are aggressively buying right now. Okay. Brutal. Come on, Bitcoin. Hold out. Hold out. Hold out, Bitcoin. Tap the VWAP right there if you can see it. Look at this. See that up there? Now we're seeing the negative reading. That means that they are offering out, so they're going to be selling. That's good news. So the data, I don't know what the statement has said, ladies and gentlemen. If anyone can provide insight into it, let me just go over to here. News, let's go. Summary of the economic projections. Where do they see it going? Here a forecast, 5.1, okay. Fed probably see the PCE inflation at 2.6 versus 2.4 in March. Projection core seen at 2.8 versus 2.6. I don't know if I like that. I don't know if I like that. Right, this is the proof of it. Vector candle recovery is just come into play, ladies and gentlemen. Please tell me if you were in longs, you were paying yourselves. Please. Please tell me you're doing that. Another flat one. Now it's even more unlikely they will hike again. Rates are holding. Yeah, the rates are holding. That's standard. I expect them to hold. It's whether they reveal that they're going to be cutting. And if they're not going to be cutting, then that only makes sense over here. Where's NASDAQ and S&P? Is this the time they caught them? Yeah, they're always going to do that. They're always going to do it. Come on. Come on. Let's see if they care. The thing is if they care. Look at that, man. I said just about 10 minutes ago, I said they did it before. Now, if this sustains itself, they're offloading the bonds. And they've been offloading the bonds because they sell as it rises. Because there are a lot of investors trapped in junk bonds. They need to offload that. If the logic comes into play, the yields are going to shoot up when Powell speaks because they're obviously not liking what they're hearing. Man, come on, Bitcoin. Come on. Don't bid out again. See that figure up there? Order book imbalance. When we see it's positive, it means they're buying. That's price is going down, okay? So that as they're going down, that means they're buying up the contracts to effectively sell it on the way back up. What a joke. Tino, I heard Wall Street maybe want to make the markets 24/7 trading. If this is the case, how do you think it will influence us? How do you think will influences markets if you think it does anything? Well, the markets themselves have now gone into the new settlement term, okay? It's now T+1. That means you can settle your transactions much sooner rather than later as it was before. A better example would be you might be on an app called Revolut, for example, and you might want to buy some shares through their app. It usually takes about 3 days because that factors in the T+2 mechanism, which we were in before. Now it's T+1, so they have to have a day. They have to finalize everything, which is good news, and it's also bad news because what will happen is investors are going to have to make sure that they've got the capital behind them to settle. That means there's going to be a rush for the denominating currency where 99% of the settlements happen in dollars. So it's all about timing, and you're going to bring a 24-hour marketplace in stocks. I genuinely think that if you have a 24-hour market, you're just going to go into the same story as we get with Forex. Forex, they don't really move too well in the Asian session. You're looking at about a 25 to 50 pip range at best of times, sometimes even less than that. And then cryptocurrency sometimes moves nicely in Asia. I mean, look at what happened last night with Bitcoin in this Asian session right here. For 8 hours solid, it just went up and down and stayed within a boring price range. I don't want to be trading that. I want to be trading these sort of movements when there's no FOMC. You know, I didn't trade today. Straight up, I did not trade. I went and bought myself a coffee. I came back home. I looked at my charts. I was like, right, let me just quickly scalp. No, I took a step back. I went and had myself a shower. I came out. While I was drying, I was looking at the chart. I was saying, I could actually scalp. No, I went downstairs and made some food. And thankfully, I didn't take any trades because my window for trading is now closed. Why? Because the move usually happens at 6 o'clock where I expect reversals. There's your reversal. Like bloody clockwork. It hurts. It really does. All right, then. So Bitcoin's coming down, which is sort of in line with what we wanted it to do. Yeah, sort of. We want it to just slump from that point, per se, from the setup. We want it to go up to then come down. So it looks like it could be on that suit. But I'm going to explain, if Bitcoin does actually rip down from this point, ladies and gentlemen, we're at a key point right now with Bitcoin. A lot of people have been buying from this point, okay? This would be the perfect time to drop it, in my opinion. Oh, am I bearish? No. Because what's going on here is liquidity is trapped. You want to see the proof of it? And we ain't even into the FOMC yet. Why are they buying? Jesus, man. Look at these guys. They're all buying up here. I hope they actually see it through. But look at the imbalance. This dude right here bought. Fantastic. What an entry point. I hope he's taking some positions. A little green area here. It pains me, man. It really does. This dude, well, he did great here to buy at this point. And if he doesn't pay himself, then he deserves a slap across the face. Come on, Bitcoin. Hold out from this point. Let's just go to the smaller time frames to put some perspective into this. Okay, imbalance is pretty big. Not good. Right, where we at? Let's bring the book map up to have a look at where we are in terms of order flow. Where's the commitment coming in? Big sell orders at 70,000. Okay, maybe this could be the little bit of a reversal to really pick up some more bids. They've come down to the VWAP, which is this white line right here. Strong support on the bids. But we still got some more bids down here. 300 Bitcoin at 67,500. Quickly going over into this right here. Let's just zoom in a little bit just to get... they're not recovering the red vector. I don't like that. Not liking that, ladies and gentlemen. Let's just have a look at who's just been bidding out for the split second. Here we go. The bids were already in there. If you've been using this, the bids were already planting themselves for this move. They were already planting themselves. Someone came in. Look, there's a partial order right there. 14 million Bitcoin. Oh, sorry, 2.8 million the initial amount, and only 662,000 of it has been traded. So 4% of it has been traded. So the logic is that they're going to recover the vector candle, the green vector, to fill those bids out. And as long as they can just keep Bitcoin within the ranges of about 66,800 and, of course, the current price point at 69, then the move is still good, ladies and gentlemen. So it could be another chance to bid on Bitcoin for a cheaper price. They're going to break that VWAP. It's going to be a problem for us, ladies and gentlemen, and we're not even in. We're not even in with the FOMC. Powell ain't revealing anything. Quickly, let's just go over and have a look at what they're saying on the news. Here we go. Let's just click this. Here we go. Monthly Treasury statement. What's that saying? Okay. No, nothing interesting. Nothing interesting on that. They didn't say anything. Keywords, economic projections. Here we go. No, we've read that already. Well, actually, hold on. The statement. Here we go. Beginning in June, the committee will slow the pace of decline of its securities holdings by reducing the monthly redemption cap on Treasury securities from 60 billion to 25 billion. The committee will maintain the monthly redemption cap on agency debt and mortgage-backed securities at 35 billion. Okay. Fed does not expect it will be appropriate to reduce... I need to go and speak to Powell. I do. Did we not just say this? Did we not just say this beforehand? We just said this. We said that the Fed is looking at it from this perspective. I just said this. They're not seeing inflation dropping the way they want it. Why? Because we're stuck in this boring range of 3.1 and 3.4. We're nowhere near it. Look at the relationship. Look at the data. This is what Powell's looking at. And I know we might break the guys back a little bit, but this is what's going on. Look, 3.4, 3.1, 3.2, 3.5, 3.4, 3.3, all-time high. Doesn't make sense, does it? So that's where you know that the market is just seeking risk for the short term. In other words, as Homer Simpson put it, bed goes up, bed goes down, stock goes up, stock goes down. And you're seeing that, in essence, coming into play. That is just absolutely madness. Ugh, God, I just hope Bitcoin just pulls the dirty and recovers and just shoots up. Because that imbalance up there it just wants the name. I'm hoping that they do that. But there's no hope in the game of trading, because we've got a very important time coming into play right now with Powell. But we just said that. It's just absolutely unbelievable. Let's just have a look at where we are with the... well, what is it? A grayscale. They were selling today. Let's just have a look and see who's been selling again. All right, so we haven't really seen that many selling on the ETF itself. ARK sold a little bit a while ago, 3 hours ago. ARK again, yeah, they're selling 820 Bitcoin, 2.9K Bitcoin, 2,900 Bitcoin. God, they sold quite a bit there. Oh my days, why are they selling so much? Okay, it's probably because Bitcoin's price has moved up. Okay, where are we at with the miners index? We saw this today. Has it been updated at all? Let's have a look where we are with the miners position index. Come on, I ain't got time for this. 10 past, let's go. Here we go. Miners are selling, and that was yesterday. So miners are selling on their BTC, but Bitcoin was going down at that point, but the reading's now coming into play right there. Okay, that is interesting. Okay, then. Coinbase. Are they buying or are they selling? Let's have a look. They're starting to buy. Retail's starting to buy, which makes sense because we've got the high block saying that it's buying. Oh, man, they're not recovering that red vector candle up there. I don't like that. Bids, where we at? Let's just have a look at where we are in terms of the bids inside of this range right now. Let's have a look. Here we go. So not so many offers. Yeah, they're starting to sell, but it's not really happening as much. I really need to see that higher because then that will say to me that we're going to keep on going higher. VWAP is right there. If they offload on the VWAP, then that's a sad story. Ah, big bid right there, man. Look, 179 Bitcoin coupled with 56 above it as well. It's about 200 Bitcoin orders there. You got a cluster of Bitcoin orders down here at 68 too. So there's a little bit of a problem right now. 68,500 could be another point of interest if they do decide to offload from this point. And that's not too far away, which will be the midpoint of the vector candle, which will then finalize the imbalances. Oh, my days. Let's just quickly go and have a look at the market tide. Greed is at 72%, 72, the greed index, whatever it is. All right, let's have a look at the coin. Sorry, the actual call premium and the put premium to put things into perspective. Here we go. Oh, my days. Look at that. Look at this. Look at the call premiums. They're shooting up. Everyone's been putting calls right there. Okay, so the understanding of this is this. Everyone's in call premiums expecting Bitcoin's price to go up, and naturally it has gone up, so they technically are in the money. But what will happen is if they recover the imbalances at speed, then those guys could be in out of the money contracts, which ain't good for them. Oh, right, let's have a look at flow. What's going on in the altcoin market? Let's see what's going on. Orbs is making some movement, actually selling off. Look at the liquidity that's coming in. Look at that. 1.2 billion on futures on Bitcoin sold. 1.1 billion on futures Bitcoin sold, all in the space of a minute. Okay, look, Spot is actually buying Spot on Ethereum on the 1 minute time frame, but there's lots of selling, man. Look, they're offloading right now. They are offloading right now. Most stocks, assets that are moving pretty well from the VWAP is BNB and Bonk. I mean, like, these assets, man, they're just absolutely phenomenal. Absolutely mad, if I'm honest with you. Here we go. What are we on? Any questions, ladies and gentlemen? Here we go. Supply has been tapped. Okay, supply. Okay, debatable. Why is greed still so high? Rebounding coming. Look, I hope the rebound comes, but they're not following through. But remember, Powell's yet to speak, okay? They just gave us that hit. Look, man, this is absolutely jokes. Again, and you know what? They were right about a boring FOMC, okay? Here we go. So it's a 23-year high. We know that, okay? But the economic projections themselves, here we go. So problem was here we go. It's the gentleman said, problem was they started raising interest rates far too late. They should have started to raise them 2 years earlier. And some guy just put his special comment, buy gold at support area. Well done, bro. Okay. And he may be right, but who knows? But here we go. Fed officials see 2.1% GDP growth in 2024. Let's just go over to here. GDP. Let me just search the GDP. US GDP. Can't use GDP data. Here we go. No. Go back. Oh, my days. All right, then. Let's look at the Treasury yield over the GDP itself. So usually... So it says here that long-term Treasury yield is an important indicator for inflation, while short-term yield is a good tool to predict the central bank's policy rate decisions. Spread between the 10-year and the 2-year bond yield changes as the economy enters in a different phase. Okay, so growth phase. Economic activity is strong and inflation expectations are moderate. Yield spread narrows as short-term interest rates. Yeah, we know this. We know this. We could be in the boom phase. Oh, no, and it can't really be in the boom phase. Nah, it's not giving me the data that I want. Here we go. Nice little recovery in BTC right now. What we got going off here? For some reason, this bull market seems to be only about Bitcoin and meme coins so far. This is true. It is only about meme coins and Bitcoin. But if we go over look at the actual Bitcoin dominance itself, see, the dominance is actually going down. And that's a problem. We need it to go up. Matic, not job. Solana, coming down. What a clown. XRP still doing nothing. Euros pulled back ever so slightly. Okay, let's have a look at gold for a second. Gold's coming back. I think gold has behaved very moderately. Oil is making the move up. It's coming down a little bit. Not really showing me much. It's not going to be happening until Jerome Powell speaks, which we will be setting up very shortly, ladies and gentlemen. We got 10 minutes or so where I'm going to be setting up the chart and be keeping an eye out on Bitcoin. And we're going to be listening to Jerome Powell very shortly, guys. So make sure you're tuning in for that. Where are we at with the likes? 912 likes, 3,200 of you amazing people. Mad love and respect for passing through. And listen, guys, if you are new to the channel and you don't, and of course we've got MEXC coming to an end with its KYC story. It's June the 30th. So for anyone in the US and you need an alternative exchange, BTCC, they've been in the game for 12 years. So heavily regulated, but they allow US citizens to do non-KYC. All you need to do is just not use fiat, because if you do use fiat, you need KYC. There's a non-KYC exchange for US guys. Everything you need is in the description of the live. Happy days. Now, as we get ready for this FOMC projection or the statement itself, the things that I'm looking for quite specifically from Jerome Powell, I'm looking for him to suggest the idea of when the cut could come into play, okay? Because if they don't cut now, well, what do we have coming out in the markets that could grant them to not cut, okay? Well, look at this. Unemployment claims comes into play tomorrow. PPI, all right? So what's the PPI? It's the change in price of finished goods. If this comes in, and look at the data here. Look, it's all over the place. There is no consistency. 0.5, 0.3, 0.2, 0.5, 0.3. It's just no consistency, which is why the Fed is saying maybe, you know, we need to wait a little bit more. And I think that's what's going to be the case. But it's going to be interesting to hear what Yellen has to say. And of course, the 30-year bond auction that comes out tomorrow is going to be a big one. But this one right here is going to be the determining factor for the dollar. Okay? Now, let me explain something. If the yen shoots up, okay, so let's just go over to it now. If the Japanese yen keeps on going up, especially when they actually declare in their press conference whether they are not if they are intervening or not, because right now, ladies and gentlemen, it does serve them to have a strong dollar because it works for them on trade, but you can see what the dollar's getting ready for. You can see what it's getting ready for. They finalized the vector candle imbalance over here. Dollar yen looks like it wants to scream to the moon. We're going to hope that they can actually break down from this point. And Powell says something that's going to be beneficial for assets to put risk on. Because if they are risk off, they're going into dollar, they're going into cash, because now will be the perfect time to sell your stock. Think about it. You had a strong dollar, okay? But the dollar is still appreciating by 3%. Look at that. 4% now. We're still at 4%. They've come back into the vector candle recovery, closed off the gap. That is a problem for me. I do not like that. I do not like that with the dollar gap right there, okay, with the red vector, which means that if the Japanese yen keeps going up, it hurts them. So they need it to stay deflated. So it needs to go down. So I'd expect the Japanese yen to go down, the dollar to go up, okay? They're going to be taking profits on this, and we're going to then see the dollar come up. That, in principle, should have an impact on assets across the board. But the idea is that when they retrace, if Bitcoin retraces, we need to see support coming inside of here. Because you don't want this to be the high that effectively sets the new low. This was the high that set the low. Is this going to be the high that sets the low? Well, we're going to know very shortly, ladies and gentlemen. And I hope it's not the case. I really do hope it is not the case. Okay? All right, then, here we go. Right, any other questions, ladies and gentlemen? Thought we wanted the Bank of Japan to have a weak yen. Yes, we do want them to have a weak yen. We do want them to have a weak yen. They need to have, it needs to be a weak yen. I bloody hope it is a weak yen. Because the weaker the yen is, the better... Sorry, no, you want a strong yen when you think about it. Because the stronger the yen, the better the euro is, the better the pound is, the better Bitcoin is, the better assets against the US dollar are. But if the dollar is weak, if the yen is weaker, that means the dollar's going up. That means euro's going to suffer, pound's going to suffer, Bitcoin's going to suffer, gold's going to suffer unless they invest, unless they get into the old, quickly go to gold as a safe haven kind of story. Okay? Now, anything else? Any other questions? What about the end of the petrodollar deal? Look, listen, in my opinion, ladies and gentlemen, the idea of the dollar itself, de-dollarization, it will only happen because the US is responsible for it. Ain't going to be no BRICS. Sorry. They'll introduce something out. They'll just say, yeah, we're going to use our own currencies to buy dollars. to buy oil. But then the US will turn around and say, okay, well, we're going to put on some sanctions on you. We can do it to China. And look what it's done to China. China's been kicked effectively from the semiconductor run. All right. They can't create any chips. Well, they can, but they've got so many limitations. That's why they want to invade in Taiwan, because that's where they're the home of the semiconductor index. Okay. So it's really like the US, you know, you think about it and you say the BRICS and what have you, let them crack on is what the US says. Okay, you're either with us or against us. So if you've got a problem, we'll just put sanctions on you, because everything that you're buying now is in dollars. And there's only the BRICS. And the thing is, though, what's in favor for the BRICS is it's emerging economies. All right, these are big places. But then again, the US is massive. Again, it's the biggest economy in the world. Like, come on, like, you ain't going to touch it. Well, Fall of Babylon, one of those ones. Tinas, tell us the story how you know what you know. What do I know? What do I know? I know nothing. I know what I see. And what I'm seeing, that's how I react. I react to what I see. You know? I'm no Greek god. No. How does Dixie and stocks sell at the same time? Well, what happens is, look, you've got to understand it. Where the dollar is right now, this is very important to understand, all right? Where the dollar is right now, if we... Whoa. So right now, the dollar is at appreciative state of 4.05%, okay? So you're getting more value for your dollars, okay, at 4%. That's where the appreciation is. The dollar dominance is made up of a basket of assets. That is the euro, the pound, the yen, the Swiss crowns, the Swiss franc, whatever, okay? A Canadian dollar, it's all in there, okay? And the weight of the dollar dominance is from the euro. The euro makes up 56%. The pound makes up 9%. The yen makes 17%. Those are really the three currencies you want to be focusing when it comes to the dollar dominance. So if you're going to be a Forex trader, you really want to focus on the euro, the pound, and the yen pairs. Primarily the yen pairs being the Aussie yen, because that's going to tell you if they are using the dollar to buy and sell stock. Remember, when this goes up, the dollar goes down because they borrow US dollars because it's lower yielding, and then take those dollars to go and invest in higher yielding or exchange into Aussie, which is what you're seeing right now. This is the Aussie pair, okay? And then they use Aussie dollars to go and buy stock. So when you see NASDAQ moving up, you see S&P moving up, you see Bitcoin moving up, Euro moving up, there's a good chance that they're all moving up because they're transacting on the carry trade principle. Okay, that's what institutional fund managers do. Because remember, they've got pools of money that they need to put to work. So then going back into your question, how does got stocks going up and dollar going up, how does that work? In response to your question, you've got to look at it like this. Right now, the value in the stock market is significant. Okay, you can see that is bright as day. Where we at? Here we go. 25 minutes. We're going to get ourselves set up for the FOMC, ladies and gentlemen. And look, value in the stock market is phenomenal right now. Okay, and I think, gentleman, is it Tim White? Michael, his name is? He made a call on 5,500 S&P. I'm calling for 6,000. That's coming very soon, I think, in my opinion. I think if they delay on the Federal Reserve cutting the interest rates, we'll go to 6,000. I genuinely think we will go to 6,000 if they don't cut the interest rates and they keep them higher for longer, because it means more money going into dollar because it's a higher yielding asset. No one's going to put their money into euro because the yields are lower. They're going to go to dollar because they can earn more. That's what you got to understand. So when the stock market's going up and the dollar's going down, you can sell your stock right now, even though it's about 38% value is in the stock market right now in terms of how much equities have risen or in a certain period of time. You're still earning more on the back of a strong dollar. Look at it. You're still at 4%. Now, if the dollar was down at 1%, then I think the stock market won't be going so high up, I don't think, because they're holding. And that's why the dollar's been trading sideways, because the stock market has been leading it higher, because they're putting dollars to work. You see, dollars being exchanged, they're using it, and there's accumulation all over the place. And the NASDAQ and the S&P have just been climbing up since. Of course, the help comes with the yields taking a nosedive to the downside, okay? Righto, let's get with the program, ladies and gentlemen. Let's have a look at where we are with Bitcoin. Bitcoin, 1 hour time frame. Here we go. We're actually going to put it onto the 15-minute time frame just to understand some potential moves. Okay, we got that right there. We're then going to get this story set up. Here we go. Let's go and have a look at alternate players. Let's just click this over here. I'm going to get ready for it, ladies and gentlemen. We're going to get the headphones. Here we go. No, we're going to get rid of that because we don't want to hear that just yet. So Powell's going to be talking here. Awesome. Bring that down to here. All right, then Bitcoin on the left of the chart right here. And we're going to have Bookmap over here. So you should be able to see that, ladies and gentlemen. Happy days. Are we all on the same page? Can we see price in the middle? We've got a green vector candle right there. That is awesome. And let's get with the program. I'm not going to let them hear that song because it's absolutely a joke when they've actually played it before. What a joke that was. Okay, then. Are we good? Can we see this clearly? Is that all right for you all, ladies and gentlemen? I want to hear Powell say he gives up and he bought crypto against inflation. That might be something they could do it. You know, they could do it. Okay, we're in 2 minutes. Here we go, ladies and gentlemen. You know what? I need a drink, man. I need a drink. Here we go. My days. I needed that. Rumor is Powell's trying to find his teeth. I'm reading the wrong things, ladies and gentlemen. EU had just cut interest rates and the US unemployment at 4% means it's only a matter of time before they start cutting. Last time they said they wouldn't cut, and a month later they did. Yeah, of course they did. But we've got elections coming up. They need the dollar to stay as strongly as they physically can. All right? Once the election's done, they said it. When Trump comes into power, dollar's going to shoot up. That's what they say. They think dollar's going to shoot up and everything's just going to go to the shoe bag. Anyway, that's another story. Come on, come on, come on. Okay. We're ready. I might be a little bit quiet because I want to listen to what Powell is saying. Okay? So hopefully... Come on. So hopefully he does say something of importance. What we need to be looking for, ladies and gentlemen, is we need to be looking at the order book over here on Bookmap. If they're going to be selling, you're going to start seeing some orders up here, which will encourage people to buy. So then price will logically start coming up. They've recovered the red vector up here to midpoint. Now we're looking for this area down here. So where we are, okay, we're nearly there. All right, so ladies and gentlemen, mad love and respect for passing through to today's live stream. Got nothing but love for you. Here we go. Let's get with the program. Here we go. All right, then. No, I can't play that music. Wait a second. Wait a second. Kill that. Okay, I think we're in. We're good. Come on, where's the boy? Here he is. Let's go. Get your cough tally in, ladies and gentlemen.
Good afternoon.
Good afternoon, sir.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Our economy has made considerable progress toward both goals over the past 2 years. The labor market has come into better balance with continued strong job gains and a low unemployment rate. Inflation has eased substantially from a peak of 7% to 2.7%, but is still too high. We are strongly committed to returning inflation to our 2% goal in support of a strong economy that benefits everyone. Today, the FOMC decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. We are maintaining our restrictive stance of monetary policy in order to keep demand in line with supply and reduce inflationary pressures. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. Although GDP growth moderated from 3.4% in the fourth quarter of last year to 1.3% in the first quarter, private domestic final purchases, which excludes inventory investment, government spending, and net exports, and usually sends a clearer signal on underlying demand, grew at 2.8% in the first quarter, nearly as strong as the second half of 2023. Growth of consumer spending has slowed from last year's robust pace, but remains solid. And investment in equipment and intangibles has picked up from its anemic pace last year. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In our summary of economic projections, committee participants generally expect GDP growth to slow from last year's pace, with a median projection of 2.1% this year and 2.0% over the next 2 years. In the labor market, supply and demand conditions have come into better balance. Payroll job gains averaged 218,000 jobs per month in April and May, a pace that is still strong, but a bit below that seen in the first quarter. The unemployment rate ticked up, but remains low at 4%. Strong job creation over the past couple of years has been accompanied by an increase in the supply of workers, reflecting increases in participation among individuals aged 25 to 54 years and a continued strong pace of immigration. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market have returned to about where they stood on the eve of the pandemic, relatively tight but not overheated. FOMC participants expect labor market strength to continue. The median unemployment rate projection in the SEP is 4.0% at the end of this year and 4.2% at the end of next year. Inflation has eased notably over the past 2 years, but remains above our longer-run goal of 2%. Total PCE prices rose 2.7% over the 12 months ending in April. Excluding the volatile food and energy categories, core PCE prices rose 2.8%. The Consumer Price Index, which came out this morning and tends to run higher than the PCE price index, rose 3.3% over the 12 months ending in May, and the core CPI rose 3.4%. The inflation data received earlier this year were higher than expected, though more recent monthly readings have eased somewhat. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households and businesses and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.6% this year, 2.3% next year, and 2.0% in 2026.
Okay.
My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. In support of these goals, the committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25% to 5.5%, and to continue reducing our securities holdings. As labor market tightness has eased and inflation has declined over the past year, the risks to achieving our employment and inflation goals have moved toward better balance.
Okay.
The economic outlook is uncertain, however, and we remain highly attentive to inflation risks. We've stated that we do not expect it will be appropriate to reduce the target range for the federal funds rate until we have gained greater confidence that inflation is moving sustainably toward 2%. So far this year, the data have not given us that greater confidence. The most recent inflation readings have been more favorable than earlier in the year, however, and there has been modest further progress toward our inflation objective. We'll need to see more good data to bolster our confidence that inflation is moving sustainably toward 2%. We know that reducing policy restraint too soon or too much could result in a reversal of the progress that we've seen on inflation. At the same time, reducing policy restraint too late or too little could unduly weaken economic activity and employment. In considering any adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. In our SCP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario going forward. If the economy evolves as expected, the median participant projects that the appropriate level of the federal funds rate will be 5.1% at the end of this year, 4.1% at the end of 2025, and 3.1% at the end of 2026. But these projections are not a committee plan or any kind of a decision. As the economy evolves, assessments of the appropriate policy path will adjust in order to best promote our maximum employment and price stability goals.
They're cutting slower.
If the economy remains solid and inflation persists, we're prepared to maintain the current target range for the federal funds rate as long as appropriate. If the labor market were to weaken unexpectedly, or if inflation were to fall more quickly than anticipated, we're prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. We'll continue to make our decisions meeting by meeting, based on the totality of the data and its implications for the outlook and the balance of risks. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to achieving maximum employment and stable prices over the long run. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Well, we got Napoleon Dynamite in the questions. Look.
Thank you, Mr. Chairman.
I can't believe it.
Steve Leisman, CNBC. Just wondering if you could walk me through the
CNBC
committee's average inflation forecast. Core PCE is now forecast to be 2.8% by the year end. It's already 2.75, and after today's number, there were several forecasts on the street that it would be 2.6 at the end of this month. Does that tell you that the average official expects no further progress in inflation, and in fact that it's going to get worse? And if you have this wrong, doesn't it mean that you could have wrong the outlook for rates there?
Go on
So
CNBC, man.
what's going on there is that we had very low readings in the second half of last year, June through December, really. And we're now lapping those. So as you go through the 12-month window, a very low reading drops out and a new reading comes in. The new reading gets added to the 12-month window. So it's just a slight element of conservatism that we're assuming a certain level of incoming monthly PCE and core PCE numbers. We're assuming, a good but not great numbers. And if you put that on top of where we are now, you get a very slight increase in the 12-month reading. Now, do we have high confidence that that's right? No, it's just a kind of conservative way for forecasting things. If we were to get more readings like today's reading, then of course that wouldn't be the case. So it's just a forecasting device. I think. Let me say that we welcome today's reading and then hope for more like that.
But if it comes in, just to follow up, it comes in the way you forecast it, it would seem strange for you to be cutting rates at all in context of a rising core PCE. Thank you.
Good point. He just shut.
I think what we said is that we don't think it'll be appropriate to reduce rates and begin to loosen policy until we have more confidence that inflation is moving back down to 2% on a sustainable basis.
He rattled him there.
That's the test we've applied. I don't know that. I don't know that this rules that in or out. I mean, really, it's a forecast, a fairly conservative forecast, month by month, that would lead to slightly higher 12 months rates by the end of the year. If we get, better ratings than that, then you will see that come down or remain the same. If you're at 2.6, 2.7, that's a really good place to be.
He rattled him. Go on, CNBC.
Nick
I like
Timrose
that.
of the Wall Street Journal. Chair Powell, if I look at the rate projections, I see 15 of the 19 that are anticipating either one or two cuts this year, fairly evenly split between the two. And so I wonder if you could explain a little bit more the nuances or the differences there. Would 2 or 3 more inflation readings, like the one that we saw this morning, make a September interest rate cut possible?
Here we go.
So as far as the SEP part of that is concerned, as you know, I talk to all of the other participants on the FOMC every cycle, and we talk about their summary of economic projections and the dot, their dot plot and everything. And what I hear and see is that people are looking at a range of plausible outcomes, and in many cases they're thinking, I can't really distinguish between 2 of these. They're so close for me. These are very close calls. But we ask them to write down the most likely one, so they do. And I think as you've said, there's 15 of the 19 are kind of clustered around 1 or 2. So I think I would look at all. I look at all of them as plausible, but I'd look at I think that does tell you kind of what the committee thinks. But what everyone agrees on is it's going to be data dependent. No one brings to this or takes away from it, that is on the committee, a really strong commitment to a particular rate path. It's actually just their forecast, and it's a combination of their forecast and their own reaction function. But again, everyone would say that this is very data dependent, and I don't hold it with high confidence. And I think if you're looking for and don't really think that they're not trying to send a strong signal that this is what I think is the right thing. It's just what they think at a given moment in time, subject to data. In terms of future meetings, we haven't, we don't make decisions about future meetings until we get there. I think in terms of what we need to see, I mentioned it earlier, we want to gain further confidence. Certainly, more good inflation readings will help with that. I'm not going to be specific about how many because, really it's going to be not just the inflation readings, it's going to be the totality of the data. What's happening in the labor market, what's happening with the balance of risks, what's happening with the forecast, what's happening with growth. You look at all of that and you ask, are we confident, have we reached an appropriate level of confidence that inflation is moving down sustainably to 2%? Or alternatively, do we see really unexpected signs of weakness in the labor market that would call for a response? Which is another thing that could happen. But again, we don't see that, and we see today's report as progress and as building confidence. But we don't see ourselves as having the confidence that would warrant beginning to loosen policy at this time.
And if I could quickly follow up, did you or any of your colleagues change your interest rate projections after 8:30 or whenever you got the inflation numbers?
Great question
today.
So
Great question.
This happens too often, but it does happen. It just is, data came, I think it happened a few meetings ago. So when that happens, when there's an important data print during the meeting, first day or second day, what we do is we make sure people remember that they have the ability to update. We tell them how to do that. And some people do, some people don't. Most people don't. And I'm not going to get into the specifics, but you have the ability to do that so that what's in the SEP actually does reflect the data that we got today, to the extent you can reflect it in one day. I think you will see PPI tomorrow. We'll know more about the PCE reading as the month goes on, but the initial CPI reading and its kind of first level translation to PCE we did have this morning. We were briefed about it, and people were able to consider whether they should make changes. And as I said, some people generally do, but most people generally don't.
Briefed about it. He was sat watching, waiting for it. Briefed. What a joke.
Hi, Chair Powell, Janelle Marte from Bloomberg. As you noted, the labor market is now in many ways back to where it was before the pandemic. I wondered if you could comment on how officials are viewing that. So do you think that there still needs to be more cooling in the labor market to bring inflation all the way down to 2%? Or is there any sense that maybe the labor market is more vulnerable now to higher rates now that many of those imbalances have eased?
Sure. So
that's how you know he can't be asked with the question.
By so many measures, the labor market was kind of overheated 2 years ago, and we've seen it gradually move back into much better balance between supply and demand. So what have we seen? We've seen labor force supply come up quite a bit through immigration and through recovering participation. That's ongoing mostly now through the immigration channel, but still we've had some increases in prime age labor force. In terms of on the demand side, we've seen well, we've seen quits moving down. We've seen job openings moving down. We've seen wage increases moving from very, very high levels a couple of years ago back down to more sustainable levels. We have seen unemployment creep up now 0.6 over the course of a year or so, very, very gradually. So you put all that together, what you have is still low unemployment, still 4% unemployment, historically low. But it's moved up a little bit. It's softened a bit, and you know that's an important statistic. But more than that, you've got strong job creation. You have payroll jobs still coming in strong, even though there's an argument that they may be a bit overstated, but still they're strong. So that's what we see. We watch the labor market, of course, and the economy as a whole, but the labor market very carefully, and that's what we see. We see gradual cooling, gradual moving toward better balance. We're monitoring it carefully for signs of something more than that, but we really don't see that.
As a quick follow-up, the surveys that make up the jobs report are showing different tales. There's been some divergence, especially we saw in the last report that we got on Friday. So how do you interpret that, and how does it change your view on the labor market?
So sometimes you can't reconcile the differences. You just have to look at it and try to understand, and that's why it always makes sense to look at a series, in 3, 6, and 12 months of things rather than just one report. But you're right to point to the last report where there were job losses in the household survey, job gains, big job gains in the establishment survey. So, we're left with ambiguous results, and we have to deal with that uncertainty around data. Nonetheless, the overall picture is one of a strong and gradually cooling, gradually rebalancing labor market. Job openings, while they've come way down, are still, greater than the number of unemployed people. The jobs workers gap is still a significantly positive number, greater than it was before the pandemic. So overall, we're looking at what is still a very strong labor market, but not the superheated labor market of 2 years ago, or even 1 year ago.
What's a boring question? Come
Thanks,
on.
Chair Powell. Neil Irwin with Axios. Back on the rates path, the SEP showed quite a large shift of rate cut expectations relative to March. That's a period in which the economic data flow hasn't been that dramatic a shift. Can you provide some color on what changed in attitudes on the committee over the last 3 months to see a much shallower path of rate cuts this year?
Yeah, the big thing that changed was the inflation forecast. So the inflation forecast moved up several tenths for the end of the year, and as I mentioned earlier in the, what did we take away from this? We had really good inflation data in the second half of last year, then kind of a pause in progress in the first quarter, and what we took away from that was that it's probably going to take longer to get the confidence that we need to begin to loosen policy. So the sense of that is that rate cuts that might have taken place this year take place next year. There are fewer rate cuts in the median this year, but there's one more next year. So if you look at year-end 2025 and 26, you're almost exactly where you would have been. Just it's moved later because of that progress. Now you get different data today. So we'll have to see where the data light the way. The economy has repeatedly surprised forecasters in both directions, and today was certainly a better inflation report than almost anybody expected. And we'll just have to see what the incoming data flow brings and how that affects the outlook and the balance of risks.
Gina.
Gina Smiley, New York Times. Thanks for taking our questions. In the summary of economic projections, the long-run interest rate forecast moved up a bit. I wonder if we should read that as a sign that you think that policy is not sort of as restrictive as we previously expected. How should we interpret what that means about how the committee views its current policy setting?
So two things about that.
Great question, Gina.
One is this.
Great question.
You're right, it did move up, but I want to remember to point out that long-run neutral rate of interest is a long-run concept. It really is a theoretical concept, can't be directly observed, and what it is the interest rate that would hold the economy at equilibrium, maximum employment, and price stability, potentially years in the future where there are no shocks. So it's a little bit, it's not something we observe today. Today we've got a very specific economy with all kinds of shocks we're still getting over from the pandemic. So it's I don't think that the concept of R-star, it's a very important concept in economics and in what we do, but honestly, it doesn't really get you where you need to be to think about what appropriate policy is in the near term. But back to your original question, people have been gradually writing it up because I just think people are coming to the view that rates are less likely to go down to their pre-pandemic levels, which were very low by recent history measures. Now we can't really know that. That's an interesting dispute and discussion to have now, but ultimately we think that things like the neutral rate are driven by longer run, slow moving forces, and there's a really good question about whether those really have changed or whether instead rates and the economy are experiencing a series of persistent but ultimately temporary shocks. That's been the debate, and we can't know. But in the meantime, we're making policy with the economy that we have, with the distortions that we have. And I also, to your other point, I think it is the case that as time has gone by, the question of how restrictive is policy has become one that everyone's asking, and we're asking it too. And my answer has been that policy is restrictive. The question of whether it's sufficiently restrictive is going to be one we know over time. But I think for the reasons I talked about at the last press conference and other places, I think the evidence is pretty clear that policy is restrictive and is having the effects that we would hope for.
Bloody hell, man. Back to Gina.
Well, thanks, Chair Powell. Howard Schneider with Reuters. Just to carry that a little further, should we read this as a conclusion, the combination of tipping to one cut this year and acknowledging further progress on inflation as kind of a mark to market on the level of restrictiveness that you need, that you in fact have concluded that you weren't quite there yet?
These women are all right in the FOMC, man.
I'd be reluctant to try to draw that conclusion. I think this is about, looking at the incoming data and asking how much progress are we making on inflation and how is the rest of the economy doing? Is the labor market still strong? That's what we're thinking about. You can translate it into the language you're talking about, but to me the focus is more on we have a goal which is price stability, another goal which is maximum employment. How are we doing there? We think we've got a good, strong labor market still. We think we've been making progress toward the price stability goal, and then for a while there was a pause, and we look at today's thing and we think, well, that's a good reading, and we hope we get more like that. And in the meantime, we're asking, is our policy stance about right? And we think yes, it's about right. We're prepared to adjust it as appropriate, but we think we're getting the things that we would want to get, broadly speaking, and that's why we've been at this policy right now for almost a year.
Okay, back to Gina.
So just to follow up on that, I think one curious thing here is you've got now this restrictive policy in place and virtually no change in any of the major things for all of this year. You've got growth that stays above long-run potential throughout the forecast period, unemployment that never goes above the long-run estimate, right, of 4.2. So this isn't a story of slack improving inflation. So where's the improvement in inflation coming from that it's going to pick up pace so much in 2025?
Well, it's been coming. Where's it been coming from? We'll start with that. Clearly, a lot of some of what we've been getting is just the reversal of the unwinding of the pandemic-related distortions to both supply and demand, and that is complemented by and amplified, supported by restrictive monetary policy. So those two things have been working together. We've also had a very positive supply shock.
There's going to be a sweep on Bitcoin,
and also you get a positive supply shock when the supply conditions unwind and return to normal. So you've had above trend potential growth and high growth, and yet you've had the benefit of inflation coming down really fast actually last year, and we'll see what the rest of this year brings. So these dynamics can continue as long as they continue. Ultimately, the question is are you down to demand? And we don't know that, though. We look at today's report. If we see more like that, we can't know what the future holds. But in the meantime, we've made pretty good progress on inflation with our current stance.
Mike.
This is the Gina.
Michael McKee from Bloomberg Radio and Television.
All right, I'm done with this. Come on.
The committee seems to be that there is going to be at least one rate cut this year.
Here we go.
But your growth forecast doesn't see any slowdown in the rest of the year, nor does the unemployment forecast see any significant weakening of the labor market. And your inflation forecasts basically average out to no change. So if at the end of the year there is no change from conditions now, why would you anticipate cutting rates? What would be the point for a rate cut?
Well, we think policy is restrictive, and we think ultimately that if you just set policy at a restrictive level, eventually you will see real weakening in the economy. So that's always been the thought, is that, since we raised rates this far, we've always been pointing to cuts at a certain point, not to eliminate the possibility of hikes, but no one has that as their base case. So no one on the committee does. But so that's how we think about it, and that's what we've been getting. That's what we've been getting is good progress on inflation, with growth at a good level, and with a strong labor market. Now, ultimately, we think rates will have to come down to continue to support that, but so far they haven't had to, and that's why we're watching so carefully for signs of weakness. We don't really see that. We kind of see what we wanted to see, which was gradual cooling in demand, gradual rebalancing in the labor market, while we're continuing to make progress on inflation. So we're getting good results here.
Well, to follow up, is there any kind of concern for the housing industry or financial stability, banks, in leaving rates where they are for too long at this point?
He should mention pricing inflation.
On housing, the housing situation is a complicated one, and you can see that's a place where rates are really having a significant effect. Ultimately, the best thing we can do for the housing market is to bring inflation down so that we can bring rates down so that the housing market can continue to normalize. There will still be a national housing shortage, as there was before the pandemic. There will still be one, but the distortions that we see now with lock-ins and things like that, low mortgages. In terms of banks, the banking system has been, solid, strong, well-capitalized, lending. We've seen good performance by the banks. We had the turmoil early last year, but banks have been focusing on bringing up their liquidity, bringing up their capital, and having a risk management plans in place. So the banking system, seems to be in good shape.
Chris.
Thanks. Chris Rugaber at Associated Press. I was wondering if we can, on inflation, if you can tell us a little more about where you see inflationary pressure in the economy. You mentioned labor markets coming into better balance, and inflation expectations appear to be well anchored. You're seeing, anecdotal stories of the large chains like Walmart and Target are announcing price cuts. McDonald's announcing a $5 meal deal. So, people may still be unhappy about prices at the grocery store, but it doesn't seem like there's a lot of inflationary pressure left in this economy. I wonder if you could tell us more about it.
I think it's true that inflationary pressures have come down, but we're still getting high inflation readings. So, and I think you can see it in various places. In some parts of non-housing services, you see elevated inflation still, and that's probably it could be to do with wages.
McDonald's made it into the life.
Goods prices have kind of fluctuated. There's been a surprising increase in import prices on goods, which is kind of hard to understand, and we've taken some signal from that. But and of course, housing services, you're continuing to see high readings there. To some extent, that's catch-up inflation from earlier pressures. But overall, you're right. Inflationary pressures have come down. As I mentioned, the labor market has come into better balance. Wages are still running, I would say, above a sustainable path, which would be that of trend inflation and trend productivity. You're still seeing wage increases moving above that. We haven't thought of wages as being the principal cause of inflation, but at the same time, getting back to 2% inflation is likely to require return to a more sustainable level, which is somewhat below the current level of increases in the aggregate.
Rachel.
Financial Times.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thanks for taking our questions. There's obviously a lot of focus on how many cuts
we know,
expected
Rachel.
this year, but can you give us a sense of what one cut by the end of the year would actually do to the economy? What you think would be
Come on,
a
great
meaningful
question.
difference if there was a cut by the end of the year, or even two?
I think if you look back in 5 or 10 years, and try to pull out the significance to the U.S. economy of one 25 basis point rate cut, you'd have quite a job on your hands. So that's not how we look at it. You know, really the whole rate path matters, and I do continue to think that when we do start to loosen policy, that will show up in a significant loosening in financial market conditions, and the market will price in what it prices in. I have no way of saying, we're not at that stage, so I don't know what we'll be thinking about at that time. But it's a consequential decision for the economy, and you want to get it right. And fortunately, we have a strong economy, and we have the ability to approach this question carefully. And we will approach it carefully while we're very much keeping an eye on downside economic risks should they emerge.
And you've been talking about this clear sense that it's just going to take longer to have the confidence that's needed for rate cuts. Is there something about what happened in the first couple of months of the year that you're seeing differently now with more time or hindsight? Do you still characterize it as expected bumpiness or something more lasting that is affecting your policy for the rest of the year?
We you always want to avoid the tendency to dismiss the parts of inflation that we don't like and just make it go away. But we had a quarter where inflation was running higher, and yes, I could stand here and say it's stuff we shouldn't have taken signal from, but it is what it is. You have to, low inflation is low inflation, high inflation. So if you have a quarter where it's higher, we tried not to take signal from the first couple of months, but we got a third month and we said, okay, the signal we're taking is that we think it's going to take longer to get confidence that inflation is moving sustainably on 2%. That's what we said. I think that was the right thing to do. I still think that's the right thing to do. Now we have today's inflation reading, which is very different, very much more positive. We're going to have to see what the trend is, what's going to be the data going forward. We're looking for something that gives us confidence that inflation is moving sustainably down to 2%. And readings like today's, that's a step in the right direction. But one reading isn't. It's just it's only one reading. You don't want to be too motivated by any single data point.
Jolene. Hi, Chair Powell. Thank you for taking our questions. I'm Jolene Kent with CBS News. What's your message to Americans who are seeing encouraging economic data but don't feel good about this economy?
Wow.
I don't think anyone knows has a definitive answer why people are not as happy about the economy as they might be, and we don't tell people how they should think or feel about the economy. That's not our job.
Yes, on Gina.
People experience what they experience.
Not Joe.
All I can tell you is what the data show, which is we've got an economy that's growing at a solid pace. We've got a very strong labor market with unemployment at 4%. It's been a long time since we've had a long stretch of time with unemployment at or below 4%, very long time. We had a period of high inflation. Inflation has come down really significantly, and we're doing everything we can to bring that inflationary episode fully to a halt and fully restore price stability. We're confident that we'll get there. And in the meantime, it's going to be painful for people, but the ultimate pain would be a period of long period of high inflation. It is people who, lower income people who are at the margins of the economy who have the worst experience, who experience the most pain from inflation. So, it's for those people, for all Americans, but particularly for those people that we're doing everything we can to bring inflation back down under control.
Ask another question.
Just a quick follow-up here. You've indicated one interest rate cut sometime this year, and I know you don't have a crystal ball up there, but a lot of people are watching and see, borrowing money remains very expensive.
Yes.
For everybody who's out there waiting on a rate cut, about when can consumers expect some relief?
Anytime, darling.
I don't have a precise date for you, but what we said is that we want to make sure that we're confident that inflation is actually moving back down to 2%. And when we are, then we can look at loosening policy. So having that kind of confidence that inflation will be at 2%, it just pays benefits to the whole economy, to all Americans for a long period of time. We had that period for a very long time. We very much want to get back to a place where people can not think about inflation. It's just not a concern in the everyday economic decisions that they make. We were there.
They know what they're doing.
And our goal is to get back to that place. And we've made good progress. And we're in the phase now of just sticking with it until we get it done.
That's the only reason why I'm watching this in the future. She's just smashed it for me.
Times. Just drawing on the change in the statement on there being modest further progress on inflation. Halfway, through the year and after today's CPI release,
those veins.
What have you and other committee members found that has been particularly encouraging to you? And just in terms of the conservatism, how much of that is about stickiness in shelter inflation in particular? Thank you.
So encouraging has been that growth, the growth clearly that we had last year, particularly the second half of last year, and we continue to see still strong growth or solid growth this year. That's been very encouraging. If you go back a year, there was a real concern about, very much slowing growth and a recession. Many forecasters had that. And that's not what happened. Instead, the U.S. is, anyway, and it's in sharp distinction with many other advanced economies around the world. So that's been encouraging. I would say that today's inflation report is encouraging, but it comes after, several your reports that were not so encouraging. You ask about, your second question was really about shelter inflation. So I think if you go back a couple of years, we know that there are renters, and then there are people who own their houses, and we have OER, which is owner's equivalent rent. And so when market-based rents go up sharply, as they did at the beginning of when the economy reopened, they really went up sharply. Those play into rollover rents much more slowly for existing tenants than they do for new tenants. And so we found now that there are big lags. So there's sort of a bulge of high past increases in market rents that has to get worked off, and that may take several years. Nonetheless, as long as market rents are going up at relatively low levels, and they still are, this is just going to happen. It just is going to happen more slowly than we thought. We also do sort of this thing where we impute a rental value to owned homes, and that's many countries around the world do that. Some do it differently than us. It's something that the price experts have regularly looked at. It is not something that we're the only country that does, and it's not something we're looking at changing or would look at changing anytime soon. But it's true. It's one of the very hardest things in inflation and in prices is how to think about, the services that someone is getting by living in a home that they could rent, but they're actually living in it. And some countries choose to just ignore that, but that's not how we do inflation here. We do it the way we do it, and we've been very transparent about it. And it's true that we're seeing delays in realizing what's happening economically, but we understand that. We understand that very well.
Right. Okay. All right. And so I think that is it, ladies and gentlemen.
With Fox Business, thank you for taking the question.
Fox Business.
So I want to go back to jobs and the consumer. The last jobs report showed that over the past year, 634,000 more people took multiple jobs. That's up 8.2%. And since January of 2021, we've seen prices rise 19%. So people are using their credit cards to pay for their lifestyle.
Okay, this is important.
What pressure points will signal to you that the slowing economy could maybe break companies in terms of hiring or break the consumer in terms of spending?
So, we monitor all the things you mentioned and more. What we're seeing is...
you know what, ladies and gentlemen, he's not really saying anything now. I think the meat of it all is no real rate cuts. There's no pressure to do it. The only thing that's pressurizing me is Jo. She's absolutely amazing. I mean, all the women mentioned in the FOMC, they just made the FOMC just that little bit more interesting, but I need to find that Jo. She was unbelievable. Happy days to that. Yeah, all day. Let's get in with some program right now, ladies and gentlemen. Mad love for everyone watching it. We had a little bit of a laugh and a joke, but let's get to the serious side of it all. Bitcoin has now made the recovery down to the midpoint at 68,646. There is still a significant amount of bids coming into play. Okay, going into the stock market to understand where we are with all of that. You can see the stock market has given some back and effectively just not really doing anything. It's just still stuck up at the highs. We just go and have a look at what's being said in the news. Just have a look at what they're saying. No one has rate hikes as base case. That is cracked out. We think policy is restrictive and ultimately, eventually, you will see weakening. Here we go. Eventually, we'll see weakening in the economy. No one has rate hike base case. Banking system has been solid. Okay, that's a joke. More Feds and ultimately expect rates will have to come down, not up. And current policy seems to be moving towards that. There's been a surprising increase in import prices on goods. Wages are still running above sustainable path. Okay, so what did he say? What is it that is really important that he can't see happening? He can't see the trend. He's not seeing the trend. It's up and it's down. It's still stuck in the zone. 0.2, no trend. Okay, it's just all stuck in a range. This is why they're calling it sticky inflation. Now all we need to see tomorrow is the core PPI. Okay, core PPI will come out and that's going to give us an understanding of the price of finished goods and services sold by producers. If this is going to be a bit tricky as well, when they're projecting it to be 0.3 and it comes in higher, then everything that Powell has just said has pretty much come into fruition in the sense where we just need to wait for the data. We need to wait for the data. There's absolutely no point. I mean, I don't even know. Let me just have a look at the yields for a second. See, look, man, the yields come up far. It's just unbelievable, man, how they play these ranges. It's absolutely madness. They came down, they got rid of the bonds now, they're selling it and the yields are now going up. Start investing in the US government. Well, let's just go over a look at the dollar for a second. Recovery, and that is yet another gap that's going to get filled. That only means that euro is coming back down again. It's just standard procedures, man. We saw that with Bitcoin. Bitcoin didn't really make the whole move. Well, we wanted 67,800 back into that to go down to 66.5. So, yeah, I don't know if we'll get 66.5 today with Bitcoin, but it all depends on how they're going to react. Bitcoin is sort of moving aggressively up to come back down again. Going into there, you've got a huge amount of bids right here, guys, and they're currently at the VWAP. So the basis of it all is what? No follow through. Green vector candle coming into play and not really going anywhere. Looking at assets across the board. Nvidia is still up, filling the gap on the wick over there. I mean, it's... Wait a second. Did I see it gap up to 120? Am I seeing things? Yeah, maybe. Whatever. GameStop's taking a bit of a tumble and Netflix not really doing anything. These are big market caps. Oil really coming down and the volatility index is going down. So, okay, risk is probably on, but they're holding it out. I think tomorrow's data is going to be a market mover. There's only so long that they can stay at the all-time highs for, quite frankly. But I'm really cheesed off with Bitcoin. Nothing really gained from that FOMC, ladies and gentlemen, other than, of course, the beautiful ladies that were hosting the questions. And they were asking genuine questions as well. You know, they did ask good questions. But other than that, ladies and gentlemen, listen, if you are new to the channel, be sure to like and subscribe. It's the biggest live, so mad love for everyone passing through. If you want any more information, make your way over to tradersreality.com. It's pinned to the top of the chat. And guys, go and enjoy yourselves, man. We know where we stand. So we'll get back to the party tomorrow for the New York Open. Mad love and respect. I won't be going live tonight. This is the last live. Take care of yourselves, gang. In a bit. Peace. I need to find that.